Gold ripping toward a number like 5,121 doesn't just move price, it moves people. You can feel it the moment it happens. The tone changes, the group chat wakes up, the headlines start sounding confident, and suddenly everyone is trying to decide what kind of move this is, because that decision determines what they do next. Is this gold doing what gold does when the world feels unstable? A real safe haven bid, slow money buying insurance? Or is this simply a rates trade, a mechanical response to the price of money, real yields shifting, the dollar reacting, positioning adjusting, and gold getting pulled higher like a kite in a changing wind? That distinction matters more than most people realize, because a safe haven bid tends to be sticky. A rates trade can be twitchy. Safe haven demand usually wants to hold. Rates-driven demand can flip the moment the next data print hits. So today we're going to do this in plain English. No fortune cookie targets, no trust me bro certainty, and no pretending that a single candle tells the whole story. We're going to map the structure behind this move, the signals that separate haven from rates, why both can be true at the same time, and what you can actually watch next, so you don't get emotionally recruited by a headline. Quick check-in before we start, comment one word, haven or rates, based on what you think is dominating this move right now. One word, then we move. Okay. First, let's define what we mean by safe haven bid. In normal people language, a safe haven bid is gold being bought as insurance, not as entertainment. It's capital looking for something that is not somebody else's promise. It's a hedge against uncertainty, against policy credibility wobbling, against currency purchasing power eroding, against risk assets falling in a way that feels disorderly. It's the I want something outside the system impulse. That kind of buying tends to come from longer horizon players. They are not buying because they think tomorrow will be green. They are buying because they want exposure to resilience. A rates trade is different. A rates trade is gold being priced relative to the cost of money. Gold doesn't yield cash flow. So when real yields are high, holding cash and bonds feels attractive, and gold feels like it has a higher opportunity cost. When real yields fall, that opportunity cost drops, and gold becomes more attractive. In that world, gold can behave like a macro equation. Yields down, gold up, dollar down, gold up, risk appetite shifting, positioning adjusting, gold moving. It's not necessarily fear, it can be math. Now here's the first thing that keeps people confused. A rates trade and a safe haven bid can look identical on the chart. Both can produce a rip. Both can push gold toward a big level. Both can make commentators sound wise after the fact. But the difference shows up in behavior, not in slogans. And if you learn to read behavior, you stop needing a perfect story. So let's talk behavior. In a haven-driven regime, gold often moves with persistence. It doesn't have to go up every single day, but it tends to hold ground. Pullbacks get bought. Dips don't feel like the end of the world. The tape looks like accumulation, not like a sugar rush. In a haven regime, gold can be strong even when the news is quiet, because the demand is about background conditions, not about headlines. And importantly, haven demand can show up even when rates are not helpful, because the buying is not primarily about opportunity cost. It's about trust. In a rates-driven regime, gold often looks more reactive. It jumps around key events. It responds sharply to rate expectations. It can surge when yields drop, and then give it back when yields bounce. It can trade like a high-quality macro instrument, but the price action can be twitchier, because the buying is more tactical. In a rates regime, it's common to see moves that look dramatic, and then partially retrace, because positioning was crowded, and the market is constantly repricing the next data point. So the title asks, safe haven bid or rates trade? Here's the honest answer. It can be both, and the blend can change over time. Sometimes a move starts as a rates trade. Yields fall, the dollar softens, and gold responds. Then the move itself draws attention. Attention pulls in longer horizon buyers. The narrative shifts from macro trade to insurance demand, and suddenly what began as a rates response becomes a haven trend. Other times a move starts as haven demand. The background feels risky, gold gets bid, and then rates move in a way that turbocharges it. Real yields fall, the dollar weakens, and the haven bid gets amplified by the math. The same outcome on the chart, but the engine under the hood is more layered. Your job is not to pick the prettiest narrative. Your job is to figure out which engine is dominant right now, because dominance determines fragility. Haven demand is usually stickier. It tends to absorb pullbacks. It tends to be less sensitive to small data surprises. Rates demand is more sensitive. It can reverse quickly if the macro inputs reverse. That's why people get whiplash when they assume a rates trade is a forever trend. Now let's talk about the level itself, because big levels create their own dynamics. A number like $5,121 is not magic. The market doesn't respect it because it's pretty. The market respects it because humans cluster around it. Humans place orders around round numbers and headline numbers. Stops cluster, take profit orders cluster, option strikes cluster, and when a level becomes obvious, it becomes a hunting ground. That doesn't mean the move is fake. It means the path can get messy, as participants fight around a crowded area. So if you're watching gold rip toward a big number, don't just ask will it hit it. Ask what happens to behavior near it. Does gold tag the zone and hold above it? That suggests demand is absorbing selling. Does gold tag it and snap back violently? That suggests positioning was crowded, and some participants were just taking quick profit. Does gold chop around it with long wicks? That suggests a tug of war between tactical flows and longer-term accumulation. Now let's get specific about signals you can watch, because you don't need a PhD to read this. You just need discipline. Signal 1 is follow through. After a strong up move, does gold hold most of the gain into the close and into the next sessions? A haven bid tends to hold ground. A rates trade can fade if the next yield move disagrees. Signal 2 is the relationship with real yields. When real yields are falling and gold is rising in a clean inverse relationship, the rates engine is likely strong. When gold is rising even as real yields stabilize or move higher, that suggests haven demand is contributing more heavily. Gold can fight yields sometimes, but when it does, it usually means the market is buying trust insurance, not just responding to opportunity cost. Signal 3 is the dollar. If gold is rising mostly alongside a weakening dollar, that is often a rates and currency trade. If gold is strong even with a firm dollar, that is more haven-like demand, because it suggests gold is being bought for itself, not just as a translation effect of a weaker currency. Signal 4 is breadth across currencies. If gold is breaking out in multiple major currencies, that suggests broader demand. That leans haven. If gold is mostly ripping in dollars while other currency charts look less dramatic, the move may be more dollar-specific. Signal 5 is volatility. Haven accumulation tends to look like a grind. Rates trades can look like spikes and reversals clustered around events. If the tape looks calm and persistent, that's more haven. If it looks jumpy and event-driven, that's more rates. Signal 6 is the news temperature. Are we in a period where risk feels tense, where markets are anxious, where correlations are weird, where credit stress chatter is rising, where geopolitical uncertainty is loud? If yes, haven demand has more context. If the news is relatively quiet and the move seems to align neatly with rate expectations shifting, rates may be dominant. Now let's address a trap. People treat safe haven like a moral label. Like if gold is a safe haven, it must go up on every scary day. That's not how markets work. In sharp liquidity events, gold can get sold too. Not because the haven story is wrong, but because forced selling exists. When participants need cash, they sell what they can. Even good hedges can be sold to meet margin calls elsewhere. So gold can dip during fear spikes, especially when liquidation is broad. That doesn't disprove the haven role. It shows you that in the short term, cash needs can override narratives. This is why it's dangerous to build your whole plan around a single day's behavior. Gold's job is to be insurance over time, not a magical shield that never shows red. Now let's talk about another trap. Treating gold like a meme asset when it starts ripping. Gold is not silver. Gold is not a casino token. Gold can trend, but it often trends in a grind. It can frustrate impatient traders who want instant fireworks. So when gold suddenly rips, people who aren't used to it often chase late, or they short reflexively thinking it must revert. Both decisions can be expensive, because the market doesn't care about your expectation of normal, it cares about flow. If you chase late into a crowded zone, you risk buying the moment tactical money takes profit. If you short reflexively, you risk getting steamrolled by sticky demand that doesn't care about your timing. So what's the adult approach? It's not prediction, it's process. Process starts with this rule. Don't let your position size turn you into an emotional hostage. If a 1 or 2% move ruins your sleep, you're oversized. Reduce the size. Your decision quality will improve instantly, and you'll stop offering your account as a donation to volatility. Now let's map out what haven and rates look like in the next phase, because the next phase matters more than the last candle. If this is predominantly a haven bid, the next phase often looks like consolidation and grind. The market may pause, but it tends to hold a higher plateau. Pullbacks get bought. The move persists because the underlying reason for insurance demand persists. The market feels like it has a floor. If this is predominantly a rates trade, the next phase can look like event-driven chop. Gold reacts to the next yields move, the next central bank expectation shift, the next economic print, the next dollar surge. The move can persist, but it can also reverse quickly if the inputs reverse. The market feels like it's trading a spreadsheet. Now here's a practical scenario tree you can use without pretending you know the future. Scenario 1. Gold holds above the breakout zone and daily ranges start compressing. That suggests accumulation. That leans haven or at least sticky demand. Scenario 2. Gold spikes, then prints long wicks and gives back a big chunk quickly. That suggests tactical profit taking and crowded positioning. That leans rates trade dynamics. Scenario 3. Gold pulls back modestly, finds support, then resumes grinding higher even if yields stabilize. That's a strong haven tell. Scenario 4. Gold pulls back sharply the moment yields bounce or the dollar firms. That's a strong rates tell. The goal is not to guess which scenario will happen. The goal is to recognize which scenario is happening, and not fight it emotionally. Now let's talk about something most people ignore: how narratives get constructed. After the move, commentators pick one story and speak with confidence: safe haven, or rates. But markets are rarely that clean. The truth is often a cluster of forces, and if you want to be ahead of the commentary, you have to think in clusters, not in single causes. A cluster could be yields easing, dollar softening, risk sentiment wobbling, and diversification flows rising. Any one of those can contribute. Together they can create a rip. So when you hear someone say, "This is definitely just a rates trade," ask them how they know. Are they measuring currency breadth? Are they measuring behavior on yield up days? Or are they just telling a story that fits the chart? And when you hear someone say, "This is definitely safe haven," ask them the same. Are they watching whether gold holds through the next rate surprise? Or are they just projecting what they want the world to be? Now I want to add a layer that helps you manage risk. Understand what your time horizon is buying. If you are buying gold as insurance, you're not supposed to be trading every wiggle. Insurance is held so you don't have to panic when other things wobble. If you treat insurance like a momentum trade, you turn it into a stress source. If you are trading gold tactically, that's fine, but you have to respect that tactical trades are vulnerable to event risk. A single data print can change the tape, so your plan has to include what happens if the macro inputs reverse. The market does not reward people who pretend their time horizon is something it isn't. Now let's talk about one more signal that often separates haven from rates: behavior when the tape should be weak. If gold holds firm on a day when yields bounce and the dollar firms, that's a sign of underlying demand that is not purely macro math. That's often haven-like. If gold collapses quickly on that same day, that suggests the move was more rates-driven. Similarly, if gold holds firm when equities rally and fear seems to fade, that can be a sign of sustained insurance demand. If gold fades hard when risk-on returns, that may suggest the move was more tied to macro positioning than to deep fear. Again, none of this is perfect, but it gives you a read on what kind of buyer is present. Now, because people love to anchor to the number, let's say this clearly: the level is not the goal. The goal is understanding what kind of regime you're in. If the regime is haven, the level can be a stepping stone. If the regime is rates, the level can be a trigger for a reversal. The same number, two different outcomes depending on behavior. So what should you watch in the next few sessions? First, watch closes. Strong closes relative to the daily range suggest accumulation. Weak closes with big upper wicks suggest selling into strength. Second, watch the next yield bounce. If yields tick up and gold shrugs it off, haven weight increases. If yields tick up and gold dumps, rates weight increases. Third, watch the dollar. If the dollar firms and gold stays strong, that's a haven tell. If gold fades, that's a currency, and rates tell. Fourth, watch range. If range compresses while price holds, that suggests stabilization. If range expands, that suggests fragility and tactical positioning. Fifth, watch your own emotions. If you feel urgent, the market is trying to recruit you emotionally. Urgency is where traps form. Now, one comment prompt, and I'm keeping it to one: haven or rates, and give me one sentence why. I want to see whether you're reading behavior or just repeating the prettiest headline. Let's wrap this up with a clean takeaway. Gold ripping toward $5,121 can be a safe haven bid, a rates trade, or a blend. The way you tell is not by guessing, it's by watching how gold behaves when rates and the dollar don't cooperate, how persistent the follow-through is, how broad the move is across currencies, and whether the tape looks like sticky accumulation or tactical bursts. And whatever you do, remember the rule that survives. Don't let your position size turn you into an emotional hostage. If a move can ruin your sleep, you're oversized. Reduce it. You'll think clearer. You'll stop chasing. And you'll stop turning a macro instrument into a personal stress test. If you got value out of this, subscribe. It helps the channel survive, and it helps me keep breaking down the mechanics instead of selling slogans. Educational only, not financial advice. I don't know your situation, and nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and stay unforced. Before I let you go, there's one more angle that's worth keeping in your pocket, because it's where a lot of people get blindsided: positioning. Even when the reason for a move is rates or safety, the severity of the move is often positioning. When too many participants are leaning the same way, gold doesn't need a big fundamental shift to travel a long distance. It just needs a small spark to force adjustments. That's why you'll sometimes see gold accelerate into a level, and everyone assumes it must be fear, when in reality it's a crowded book getting untangled. You can't see positioning perfectly, but you can infer it from behavior. If the market is ripping and every dip is instantly bought with almost no patience, that often means the crowd is leaning long and chasing. If you see sudden sharp pullbacks that recover quickly, that can mean late longs are being shaken out while stronger hands absorb. If you see the opposite, sharp pullbacks that keep bleeding and don't bounce, that can mean the move was mostly tactical and the buyer is stepping away. Another clue is how gold behaves around scheduled events. In a pure rates regime, gold can feel like it is waiting for permission from the calendar. It drifts, then explodes on a data print, then settles, then waits again. In a haven regime, gold can look like it doesn't care about the calendar as much. It can keep grinding even on quiet days because the buyer is not trading the next headline. The buyer is hedging the next year. And one more thing, pay attention to how people talk. In a rates trade, the language is usually technical and conditional. People say if yields, if dollar, if cuts. In a safe haven bid, the language becomes moral and emotional. People say protection, collapse, insurance. They're printing, you can't trust. Neither tone guarantees truth, but tone reveals the kind of crowd that is showing up. And the crowd matters because crowds create fragility. So don't just watch the price. Watch the tempo, the reactions, and how the tape behaves when it should weaken. That's how you tell whether this move has roots or momentum.